How's everybody doing this evening? Y'all awful quiet. Come on, can we get a little applause in here? Let's go. We here to learn something. All right. For those that don't know me, my name is Henry Rucker. I am the financial coach and homeownership manager for Project for Pride in Living, better known as PPL. And we are here today to talk about your asset, your home. How is that an asset to you, the wealth creator? Hopefully it's something that will pass down generational wealth. We have a panelist here. I'm going to give them a second to introduce themselves. And we're going to start here to my right with Christina.
Good evening. Oops. Good evening, everybody. My name is Christina Aknola. I'm with Minnesota Housing.
Good evening. I'm John Archambault. I work with the Minnesota Department of Commerce.
Good evening. Max Sapia with the Minnesota Department of Commerce.
Trent Bowman, Bremer Bank.
Bill Schweitz, Summit Mortgage.
I'm Tim Bolger, the City Assessor for Bloomington.
Good evening. I'm Sophia Farah with the Department of Revenue.
Thank you all, and welcome panelists. So let me ask you guys this. We're going to kind of go in a reverse order. We're going to kind of go a little bit out of order, but everybody here is a homeowner. If you're a homeowner, raise your hand, no matter if you're on the panel or not. Okay. Let me ask you a question just to start a little bit. What made you buy your house?
I took over the house I grew up in.
Okay. So that's definitely a sign of generational wealth. Who else wants to share why they bought their house? Y'all quiet. Well, I'm gonna tell you, I bought a house because my parents told me I had to buy a house because they weren't gonna allow me to be long-term renters. And I've been in my current house for 22 years this October. It's probably the best thing I ever did. For one reason, I know what my mortgage payment is every month. It allows me to do what I want to do on my property. But how do we protect that asset? We're gonna start here with John, and if you can tell us, John, why is having the proper insurance is something we want to make sure we have taken care of?
Well, your house is your most important asset that you have. It might be the largest investment you've made. It's an asset that is going to grow and create generational wealth, possibly. And also, it's just your house, your home, where you go to be comfortable and secure. If you don't insure that, your home, you're going, in a case of an emergency, you're going to lose that house, and you won't be able to rebuild it. So it's necessary to have insurance to cover emergencies and to protect the most important financial decision you've probably made.
So let me follow up on that. How do you know if you have the proper insurance? Let's say I bought my house for $300,000. How do I know I have the proper insurance if my house is worth $300,000 based on the appraised value and what I purchased it for?
Well, that's for 99% of loans. The insurance coverage is going to be decided by your lender. And there are guidelines by government entities, agencies, that ensure that there's enough coverage so that your house can be rebuilt in the case of an emergency, or certain items could be replaced. So there's no real worry because those guidelines are already there to protect you. Now, in other situations where you own the house free and clear, like maybe you do, you can not have insurance. There's no law that requires you to have insurance, but you should.
It's a great answer.
Exactly.
I grew up, my father had insurance, and we had to have insurance. I don't know, I'm going to tell how my insurance is set. It's not that one big account number. It's in little sections. Like, here's for building the house. This is for rental, because you can't live if it's being rebuilt.
Yes.
Major clients. Any like buildings on other than the house. We got some sheds on there, and also regarding the grass area and the trees. That's all in different sections.
Yeah. So you don't need insurance. There's no law, but good thing you do have insurance because it's protecting your house, your home, and without that, you wouldn't have one.
We're not required to have health insurance, but it's a smart thing to have.
Exactly. Now there are other insurances, flood, insurance that you may need if you live in a flood zone, which will be told to you by the lender, which is the government basically states, hey, this is in a flood zone. But then also you may know that you live in an area that floods often. In that situation, you can get additional flood coverage just in case. And that's really your personal decision about the risk you want to take with your house.
Right, so we're gonna kind of pause on that for a second, because I think, ma'am, if you don't mind sharing, what's your first name?
Jane.
Jane? Jane, thanks for sharing. So, Bill, this kind of leads into your question. Jane inherited her house from her parents. If I'm a new homeowner and Jane inherited her house, what does our equity position look like, Bill? What is equity?
Well, equity, good question. Equity is the portion of the value of the home that you own. So, if your house is worth $300,000 and you have a $200,000 loan on it, that means the rest of it, the other $100,000, is your equity. That's what you own. If you inherit a home, that's fantastic. You probably don't have a loan on that home, and the whole value of that home is your equity. And that equity can be a financial asset for you. You want to be careful with it because it's also your home. But, if times in your life where you need extra cash, there are times that you could take out a home equity line of credit or refinance your home and grab some of that equity, turn it into cash, and use that for schooling or other more important things in life. You probably don't want to dip into your equity in your home for a vacation or to go to the casino or something like that. That's just not a real good thing to do. But it can be used to improve your life, to improve your situation. Just remember, homes generally go up in value, and as you're making payments on your mortgage, that mortgage amount will go down. But homes don't always go up in value, so be careful. It is your home, and it's your most important asset.
Someone asked this question to Sophia. From a tax purpose from the Department of Revenue, how can equity affect me from a tax purpose standpoint?
Wait, can you repeat that?
From a form of equity, how do taxes play a part in your equity?
Taxes play a really big part. There's so many different ways you can actually get tax credits, and knowing all different type of information that we can provide to everyone. So there's like tax credits you can get from like K through 12 for your there's a lot of different ways you can also get equity towards your taxes just by knowing what your property taxes are in general.
Okay, so let me also ask this, and I'm gonna pass this back to Max, that's sitting next to Trent. I have equity, right? Bought my house 22 years ago. Let's say I don't have a mortgage on my house. Or no, let's say I had a $100,000 mortgage on my house. How do I know if it's a good time for me to refinance or not?
All right, so the thing to know about refinancing, in my opinion, is what is your plan for the house? So if you have been there 22 years, you plan to be there another 22 years. Thank you. If you've been there 22 years, you plan to be there another 22 years, the chance that you will be able to recoup your savings on a refinance are slightly higher. The other side of that is if you are just in there, like when we first bought our house, we were only going to stay there for 3 to 5 years. There's very little chance that we'd ever make the money back by refinancing, and also very little chance we'd ever make any of our equity back by doing major home improvements. After that, it's a question of what the interest rate market is doing. So interest rates are substantially higher than they were a year ago, and they certainly are way higher than they were kind of at the peak of the pandemic in 2020. If you have a loan that has a lower interest rate, be real careful to make sure that whatever benefit you will get out of a refinance is going to be worth the added cost, not just in the upfront costs of sometimes 3% of the loan, but also the extra payments and interest you'll have going forward.
Say, Henry, can I add to something Max
You
said?
sure can.
Yeah, I like what Max had to say. And the purpose of, there's a couple purposes for refinancing. Actually, there's three. One is to lower your payment, and that's what Max was talking about. If your interest rate is at 6 now and you can refinance to 3, which you can't anymore, but if you could, that would probably make a lot of sense as long as you're in the house long enough to recoup the closing costs that you have to pay in order to refinance. So it's a little bit of a math problem. Are you saving $100 a month, $200 a month? How long will it take to recoup those closing costs, and will you be ahead while you still own that home? Another reason to refinance is to shorten the term of the loan. If you have a 30-year loan and you're on your 25th year, and you're thinking, interest rates are pretty good, and I can get into a 15-year loan and shorten that term, you'll save yourself a lot of money. So your payment might even go up, but you're going to pay that loan off so much quicker. If you're going to stay in that house that long, you're going to save a lot of money in interest. And the third reason to refinance has to do with dipping into your equity, like I had talked about before. And refinancing might not always be the best answer for that. If you have a real low interest rate loan and you want to get $20,000 out of your home, maybe a second mortgage is a better idea than rewriting that whole low interest rate loan into a higher interest rate loan. So,
Okay,
thanks
I
for
like
that.
where you went with that. So let me ask you this, Mr.
Can I just, I'm sorry, can I add on to that one
Sure
more?
can.
This is something that's really important to me. If you're going to tap into your equity, Bill said there's multiple ways to do that, which is true. Just remember that a mortgage or a second mortgage is really long-term debt. And you should make sure whatever you're doing with that equity has a comparable match so that you aren't paying off for potentially 30 years something that really only had value for you for 6 months or something.
So we're gonna come back to that, but I wanna bring Trinity to this for a second. So I got this $100,000 worth of equity. That means I probably don't need to really have any money saved up, right? I can just use my house money to, get a new roof or, get a new hot water tank, get a new boiler, furnace, whatever I need. Talk to us about reserves. Why is it important for us to maybe have reserves, and what are reserves?
Thank you, Henry. Good question. And reserve funds allows a homeowner to manage emergencies that will pop up, that'll pop up and that you don't necessarily see coming. We always talk about, house debt. One of the things we talk about when we do a consultation, when you sign on that dotted line, you're going to inherit house debt. And the house debt is that stuff you don't see coming. So that's why it's so important to have a house you can afford, something that you can, having a manageable mortgage so you can put money away each month. A house that is too expensive can take away the ability to save. I mean, that's the whole purpose of buying a house, is so we can save, we can put money away, and we can have those reserves. We have to look at our spending habits, what are some of the things that we do? When you purchase that home, some of the things you did when you were renting, you may not be able to do when you become a homeowner, because it's important to put that money away and kind of, discipline yourself from those unnecessary purchases. I'll say that again, unnecessary purchases. And I think all of us in the room have our habits of unnecessary purchases. So those unnecessary purchases can add up. And they can take away from your ability to save in case, again, things are going to pop up when you own a home, because you are going to inherit house debt. So if that furnace goes out and you're making unnecessary purchases, now you don't have the necessary assets to be able to fix that furnace, or you're ending up charging or putting it on a credit card or financing a furnace or a water softener or some of the major things that can happen in a home. So we've got to identify the areas where we can cut back. This is going to help us build our reserves. And again, it just really boils down to that discipline. Owning a home, you have that structure, you have all the bells and whistles, but what are we buying the home for? Are we buying the home to manage, to maintain a lifestyle, or are we buying a home to impress our friends and our family? This is why a lot of times what we see is people buying more home than what they can afford, because now you're living for the home instead of living to build that equity and continue to build that generational wealth within the family structure.
So Bill and Max kind of touched on this as well. And so let's say I don't have the adequate reserves. I don't have $20,000, and I get a letter from the city of Bloomington that says I might need, or no, let's say the insurance company says you need to get a new roof, right? I got a 590 credit score. Can I walk into a lending institution probably and qualify for a mortgage, even though I have that $100,000 equity? How does that work? So tell me, from a banking standpoint, Bill and Trent, how does that work when it comes to maybe refinancing? And Max, you can jump in as well. If I have the $100,000 worth of equity, but I don't have the credit score, how does that look?
You don't have the credit score, but you have the equity.
Yep, so I have $100,000 in equity, and my average score is a 590, I said 590.
Well, I'm going to hand this over to Trent, but then I also want Christina to maybe say some things about what Minnesota Housing has. Don't they have a home fix-up fund where you can, I think
We
that's
do.
probably where I would go. But
We do.
Well, let me try to tackle it. So if you've got a 580 credit score and you got $100,000 worth of equity, well, most lending programs don't have a product that's going to allow you to refinance in some cases. Now, if your equity is strong, there are some lenders out there that will do a cash out refinance where you can take care of some of that debt that's out there, but that's what they call overlays. But so if there's a lender that has an overlay that's going to allow you to do something with a 580, then that might be the route. But I caution you on that, because now you can really put yourself in a higher interest rate. So the responsible thing to do is, again, you didn't get yourself in trouble overnight with that low credit score. So we've got to work with one of our nonprofit partners to go into that credit empowerment phase to start rebuilding those credit scores, or that credit score, one account at a time. So a lot of times what we do, Henry, we see our debt has gotten out of control, and we think we want to fix it overnight and think it's going to happen overnight. But what we got to do is we got to partner with our nonprofits and just take one account at a time, get one victory. And we all like winning. So when you take care of one account, then you're going to start seeing that score start to gradually go up. Then you see another account and you take care of that account. Remember, what you want to do is you want to protect that $100,000 of equity that you have in your home. You don't want to lose that. So you want to make the necessary and get with the necessary organizations that's going to help you and guide you in rebuilding your credit score, so you can get to a level at some point, if you did need to refinance to lower that interest rate, or you needed to get a home equity line or something of that nature, now you put yourself in that position to do that.
Right, so we're going to switch the scenario here and say you don't have the 590 credit score. Now you have a 680 credit score. What could they do with Minnesota Housing, Christina?
Thank you for that. Thank you for passing that over to me. So I want to build a little bit on what Trent said. Bottom line, it's pretty difficult to do anything with a 590 credit score. So pretty much a homeowner is in a little bit of trouble with a 590 credit score. So after you do what Trent said, you built your credit score up, you work with the nonprofit, that credit score is built up to a certain level. Minnesota Housing has home improvement programs that you can get into to help improve your home. Now, that would help save the equity in your home. You don't want to use your home as a piggy bank, right? We don't want to use your home as a piggy bank. The state, which is Minnesota Housing, we have home improvement loans that you can work with our partners throughout the state. We have a network of about 130 lenders that utilize our home improvement loans that can help you get the money that you need to get into to fix up your home, improve it, improve the equity position that you're in, to improve that home, accessibility improvements, as well as I lost my words, sorry. So the improvements that you need to do, you can use a home improvement loan to do it. However, again, like Trent said, you have to build your credit score. So you would work with the nonprofit, get your credit score up to at least 680 in order to work with one of our lending partners. And then with Minnesota Housing Programs, we have programs that range between $2,000 all the way up to $75,000 that you can use to improve your home.
So yes, ma'am, you have a question?
Yes. What is the range for the interest rate for those programs? You have the amount
So that's a great question. And it's difficult to answer on the spot because the rate changes, just the way the market changes on a daily basis. So whatever the going interest rate is at that time or at that day, that's what the interest rate is going to be. So our rates are competitive. So coming to the state of Minnesota, you're not necessarily going to find the lowest rate out there, but you're not going to find it to be higher. So it is competitive with whatever is out there. The really cool thing about the home improvement programs that the state has is you can amortize the loan. If you borrow $10,000 and above, you can amortize it over 20 years at that low fixed interest rate. And just to put this out there as well, if you have a project that you've already started or completed within the last 120 days, you can refinance it into that fixed interest rate that Minnesota Housing has for you.
So let me ask you this, because I think this is where some people get confused. Does Minnesota Housing actually do loans?
That's a great question. Thank you, Henry. So we don't. So as the State Housing Finance Agency, we are an arm of the state government, and therefore we have lending partners throughout the state that work with our programs. They apply to us to become approved, and currently we have 130 lenders that offer our home improvement loans throughout the state. That list can be found on our website, mnhousing.gov.
So I want to bring it real back to Tim with the city of Bloomington. So Tim, I believe my house is worth $300,000. I live not too far from here, just a few blocks I could walk. I was a little lazy, so I drove, but I could walk, right? And I think my house is worth $300,000. How do I know, or what do I do if I believe my tax assessed value per the city of Bloomington is not what I think it should be at? You guys say it's worth $250, and I think it should be $300. First of all, do you ever have that happen to you?
Well, first off, I need to apologize. I didn't know we were doing blazers here, so feel a little naked up here. But so typically we don't get that where our assessed value is low and they want it higher, because the assessed value is what your taxes are based off of. But we get the reciprocal quite frequently. We mail our valuation notices out every March, and then we receive 600, 700, 800 phone calls from taxpayers questioning that value. And most of the time, it's just an education process, what we do, how did we come up with the value, what the market's doing, that kind of stuff. And we're happy to have those conversations. We love to talk to people. We love to explain how our very, very convoluted tax system works. But if you do believe that your value is overstated in the assessment, we're happy to walk you through that. We typically ask you bring something to the table, whether it's a recent refinance or a purchase price or some neighbors' homes that sold that are very similar to yours. And what we'll do, we'll come out, we'll take a look at your property, do an inspection, and then we'll actually put a comp grid together, much like you'd find in an appraisal for lending. It's not going to be all of the narrative and all of that. It's mainly the grid. We'll find 3 or 4 similar sales that occurred recently around your neighborhood, similar size, age, all of that stuff. And then we'll make an adjustment like a normal appraiser would do and come up with a value. And oftentimes we'll find that that value is within that range and our assessment was good, but when it isn't, we're happy to make that adjustment for you. Yeah?
Have you ever had an instance where your assessment is actually more than what the documentation says, so then actually it's kind of like a negative thing that the person has actually reached out to inquire about doing an assessment?
Yeah, so we see this often, and really we're just doing our due diligence and we're walking through the process and showing them how we came up with that value. We're never punitive. So if our second look at it with the comp grid says, hey, our assessment was actually too low on this, we're not going to increase your assessed value. We're just going to say, hey, we'll let you dismiss it, and next year let's chat if you still think it's in a bad spot.
So they have a very hard job, and it's great to hear that it's never punitive. I will note from the consumer's perspective is there's some great online sources of information that you can go get about your property, comparative sales in your area that you can bring to be armed to have more information for those conversations.
And again, yeah, we love to see that when someone comes prepared and they're a bit knowledgeable about their neighborhood and their property. We love to engage in those types of conversations. We're also happy to educate if this is your first time through this process. We don't want it to be daunting. That's the last thing we want. It's not supposed to be unapproachable. We want this process to be fair and make sure that everyone has an equitable and reasonable value on their property, because it does determine what you pay in taxes.
So this is kind of a two-part question for Max, I'm sorry, for Sophia and for you, Tim. So I get that statement in March. You said it comes out every March?
Yep.
Should I give that to the person doing my property, to my income taxes?
So this would be just your valuation statement. The income tax piece, there's some property tax refunds that are available, and so that's what you would give your tax preparer if you have one. And those, there's a few different property tax refunds available. There's the renter's refund, which we're not talking about today here, and then there's the homestead refund, and then the special property tax refund. Now the homestead refund is income restricted, and I can get that information for you after the meeting here. The special property tax refund is not income restricted. And this year in the legislature, they changed the limits for a one-time deal. They upped the payouts by about 20% this year here. So it is available for everyone. The special refund that is capped by not capped by income restrictions, that is held between year over year if your taxes went up at least 6%. And then there's no limit on the normal refund for homestead.
Okay, and then Sophia, can you touch on the updates on the new tax law? Minnesota homeowners with I-10s can qualify for homestead credit refund.
Yeah.
I just have one question for Matt. You said that homestead is non-income and the other is income. What does that mean, income? What are you talking about?
So I'd have to take a look at the limits. There's a restriction on the household income. I don't want to misspeak, so I'm not going to say that number, but no. So your household income, there's a limit to which refund you would use. And now all of this, to preclude all of this, you need to be homesteaded on your property to qualify for any sort of property tax refund. And so
Yes,
that'd be the
ma'am.
first step.
So I can help out with that. My name is Nico. I'm from the Minnesota Department of Revenue. I'm just here to encourage Sophia for a great job she's doing. But for the homestead, the income limit is $119,790 is the total household income. So not just your income, but the total household income in that household.
So can I ask one question on that, about the household income? Because I know sometimes on the mortgage side, we count adults that are 18 living in the house. Is that the same for that as well?
So anybody who's in the house who's working and has over 18, that's total income.
Okay, that's good to know. Sophia, can you tell us about the I-10s where somebody can qualify for homestead credit refund?
Yes, so Matt had let you guys know that there has been a few tax law updates, and one of them does include that you can now, homeowners can file with their I-10, and you can qualify for a homestead credit refund. Your property must be homestead by December 31st. And you can also reach out to your county assessor if it is already homestead and let them know that you would like your property homesteaded. So.
And I want to add on to that.
Yes.
So make sure that you get your property homesteaded and then get a document from your county stating that it's been homesteaded, because I'm sure it will take a process to make the update in the system. So when you get that document, go to your tax preparer and file a return with that document. That will get submitted with it, so you get homestead. You can only claim that credit for the current year, not 2021. So 2022 you can.
Okay.
Henry, can I ask a question since we got the tax people here? When can we start writing off our interest so it makes a difference? Because they put that $12,000 or whatever thing on when we file our taxes as a homeowner. You know, a lot of people, when they buy houses, they buy it because of the interest, because you can write off the interest. But since some previous president got in office, the interest is really we're not seeing anything from a refund standpoint. So has there been any discussion on that, and is that law going to change?
No discussions that I'm aware of, but I know as a homeowner myself, when I get the statement from my bank and I have the interest or how much interest I paid, I take that to my, I do my own taxes. I take it, I just do it, I just put it in the software about how much taxes I paid, and then that will deduct, or that will write off whatever I qualify for based on income.
Right, but they put that flat. Isn't it the a flat line. I think it's like 12,000, what you can earn in interest, and once you, so really that takes away any interest that we can get back, because when I bought my home many years ago, I mean, we were getting a nice little refund back, really based on the interest from our home. Now it seems like that thing has really kind of taken away that opportunity to really write off interest from your properties.
Yeah, I don't know if there's any changes on that.
We should work on that.
We'll have to find that out for you, Mr. Bowman. Yes, ma'am, you had a question.
I did. So if, I know I do file the homesteader credit when I file my taxes. What is the change that has actually, what exactly was the change that has taken place with the legislation? Like what would be the difference from, what I've previously been doing to now? I mean, I haven't filed, say, my 2022 yet. Is this something that I can take advantage of when I go to file?
Yeah, so the changes in legislature for 2024, the major change regarding homestead is they changed the market value exclusion level from 413,800 up to 517,200. So what that means is homes in that range will now qualify for homestead market value exclusion that previously didn't. This also increased the maximum exclusion to $38,000. I think it was around $32,000 before. So, kind of the way that works, it's a progressive in nature exclusion. So homes at the lower end of the spectrum receive a larger exclusion. And just to back up slightly, so the estimated market value that the assessor sends you is not the value you're taxed on. So that's our value, what we think the market value of your property is. Then you have a taxable market value. So that's our value minus any exclusions, like the homestead exclusion. So for Bloomington, the median value home is $361,000 and some change. So your homestead market value exclusion would be about $14,000 on that property. So you'd be paying taxes on $347 instead of $361. So that was one major change, is they increased the upper threshold for homestead exclusion. The other major change on the property tax refund is the homestead credit refund and the renter's refund. They increased the maximum by 20.5% just for 1 year. So it's just a 1 year catch up because of how the real estate, yeah, correct. And then also on the special property tax refund, that's the one that's not income constrained. They changed the maximum refund up to $2,500, and to qualify for that, it had to have increased 6% year over year instead of the 12% it previously was. And again, that's a 1 year kind of stopgap. They're trying to catch up with what was happening in the real estate market, and give some relief to some of these property owners where their taxes went up, pretty significantly over the last couple of years.
I want to ask you a question too. I'm gonna go back to John here. What do you guys see from the state, from the Department of Commerce level, of the deductibles people are paying? Is a good deductible $250, $500, $750, $1,000, $2,000? What do you think about that? What are you guys seeing from the Department of Commerce?
They're all over the place, honestly. But the higher the deductible you're going to pick, the lower your insurance premium is going to be. So if you are having a large issue paying your monthly or your yearly insurance premiums, then you could start playing around with getting a higher deductible. But you are at higher risk when you actually do have to make a claim, because you're going to have to cover that deductible. You're going to have to first pay $25,000, whatever. There are limits to this by the lenders or by the lenders programs. But those can get up to $25,000 deductibles, I believe, which is quite a bit. I wouldn't want to do that. I would rather be in the 5,000 area. But that will drive your premium up. So I don't know if that answered your question, but.
It did. The reason I asked that is I feel like sometimes, I think Bill and Trent can speak to this, and I know Christina's probably seen it too, the number of years she's been at Minnesota Housing, is sometimes we have people pick the lowest deductible. That's not always the best. Right, sometimes it's better to have the higher deductible than really understanding what your insurance policy is actually covering, right? And I think that's where we see sometimes people pick the lowest deductible, but they don't also have the best coverage, right? Now, again, as I say this when I teach class, this is a Henryism, typically for most times, if you have a $2,000 deductible and your roof is damaged and it's going to cost you $20,000 to have it repaired, the insurance company's normally going to cut a check for $18,000, not $20,000, because they're going to be minus the deductible, roughly, right? Most roofers are going to get that job done for $18,000, right? Not saying it's going to be guaranteed. The reason I bring this up is because I do feel like the longer we're in our homes, we want to make sure we're checking on our insurance to make sure it's the best coverage for us. Because when you bought a house 5 years ago, it's a little bit different today than it was when you first bought it. So how often do you guys also suggest that we maybe have our policy reviewed, maybe even by a competitor or by the current company, to see if we have the best policy in place?
You should do that yearly if you really think that you're getting a bad deal or that you're worried about the coverage. Just call somebody. You can call your own insurance agent, or you can call a competitor to get a different idea or a different quote. But there are, when you brought up the lower deductibles, I like lower deductibles, but it does increase your premium. That is going to increase your monthly payments, so you have to be aware of that. Additionally, you brought up make sure there's coverages. There's a new product that I've read about, at least, called inflation protection. I don't know if that's going to apply to a lot of people here, but if your house repair or rebuilding is too expensive for the amount that you get back in insurance, and the increase is due to inflation, insurance companies are now providing this inflation protection that can cover the difference. It's like a second insurance, kind of. And I think it really only applies for large projects that will take a year or so to finish. And then by the time the repair starts, to the prices at the time it starts to what time it ends, it's increased so much that your insurance funds won't cover the rebuilding. So that's a product out there. I don't think it's going to apply to many people. I think it's really just wealthy people with very large homes. So just think about it. That's about that.
And I'm going to give this question to, yes, ma'am.
Sorry.
No, go ahead. That's what we're here for.
I guess, I don't want to sound kind of weird, but, it is kind of like a thing to do to like reviewing your insurance. But like, for instance, I pay my mortgage every month, it goes to the escrow, and, from there it divides up, where it needs to go, taxes, insurance. Is it really as daunting to take on that task to review? Because I kind of feel like I want to review my insurance to see if there's a competitive, if there's a better rate. But I feel like the process of, how exactly does it work? Like, am I now going to have to figure out the escrow portion, or how much really effort would I have to go into getting all of that situated?
So,
usually your lender will take care of that for you.
Okay, so just I contact my lender and let them know I'm interested.
Well, the new insurance provider
Okay.
will contact them, and they'll just switch over your escrow account.
Oh, okay, so I do my diligence to find the new insurance provider, and then I just call my lender and say, hey, I want to now go with Progressive or something.
Or your agent will do that. They'll call your lender and just says, hey,
It works pretty slick.
It does work slick.
And,
You get a credit.
and this potential savings are significant, especially if you've had a plan for a long time. There's a lot of different ways to get insurance. One thing I'll just add to this is, unfortunately, it's not as simple as having insurance versus not having insurance. There's a third option, which is underinsured. This comes into play a lot more when we're talking about small businesses, because homeownership is such a highly regulated industry. But you should still, when you're reviewing your insurance, make sure in a what-if analysis, my neighbor burns my house down with his fireworks, is the amount they're going to pay me going to make me whole? It may not, in which case you should really look at that.
Man, Max took the words right out of my mouth.
Sorry.
So,
No,
it's good, because this is what we talk about when we're talking with first-time home buyers. Sometimes cheaper isn't always better, but find out the what if. Ask the what if questions. Even if you currently have insurance and you're looking for a new provider, same thing. Ask the what if questions. Come up with 10, 12 crazy scenarios you can think of. You guys see that commercial, the Mayhem guy? Think, that's reality. So think about these things and then ask your insurance agent, if this were to happen, am I covered? So you don't get surprised, because none of us want to hear those 3 words. You're not covered. We don't want to hear those words. So ask the what if questions. Whether if you currently own a home, you're looking to switch your provider, or even people who are looking to buy a home, ask the what if question. So I just wanted to.
Yeah,
lay
thank
on
you.
Can
that.
I add one last thing to that? So personal experience, my escrow amount went up about $400 a month, and I was completely freaking out. And that was what made me reevaluate my insurance. So I called an agent. They couldn't help me. I called my sister. I was like, this is ridiculous. She gave me the name of her agent. It was her agent. So just to tell you how easy it is, gave me the name of her agent. She's a broker. She compared with a lot of other insurance companies. Not only did I save that $400, she got me it less with better coverage. So I didn't have to do a thing. So like you, my first question was, I was thinking I would have to call my mortgage company, figure out the escrow. Nope. She figured that out, called my lender. They changed insurance companies, figured out the escrow. It was as easy as whatever you can imagine. It was just so easy.
Just get a letter saying that my escrow might increase
Yeah.
a certain amount.
Yeah.
And so I'm always overpaying on my mortgage, so I can pay towards the principal.
Right.
So I'm still fine because I've been overpaying, but then I'm still losing that additional cushion that I've been paying for all this time. So then I guess I was kind of surprised by the letter, but it probably still would be very advantageous now for me at this point to go ahead and try to see if I can get a better rate. Because I mean, increases happen, but I'm missing out now on my extra cushion that I've been paying towards my principal.
Absolutely
So
true.
just one thing, I just want to give you kudos for doing that to your mortgage, because it is extremely financially beneficial. If people didn't hear, she said she put extra down towards the principal. That was what you said? And that, if that fits, if you have the safety net for the roof and whatever, is a very, very effective way to save money over the long term and build equity real fast.
I mean, it's not that much, but I mean, I just, as things change, I get promotions, I kind of like, I can maybe pay now this amount, and I try to look at it as more than what it actually is, so I'm not really complacent with that amount because it can change at any point. So I try to go above what I'm doing, and it's only a small amount,
But it adds up because it's the last dollar you pay. So every dollar you do that is potentially up to 30 years of you not paying interest on even just $1. That's a lot. So
The rumor is if you pay one extra payment per month towards your principal, you knock off 5 to 7 years of your mortgage.
one extra payment.
Yeah.
Per year.
Per
Per
year.
year.
Per year.
So they're, for one extra payment.
You're basically paying
So if I
bi-weekly.
take my monthly amount.
Yeah.
Oh,
Yeah.
Can I say a couple things
You
about
sure
escrow
can.
and insurance? So first, your escrow payment is going to go up every year. This is just a common thing that's happening. Taxes are going to increase at the county level, but then also your home insurance is going to increase too. And we're in a period of a great increase. These last 3 or 4 years, insurance premiums have been skyrocketing. And probably has a lot to do with home values increasing, because now your home is more expensive and it's going to be more expensive to rebuild. So there's that. Now, you brought up undercoverage. There's 2 main products in the insurance that you're going to get, which are actual cash value and guaranteed replacement. Guaranteed replacement is going to say, basically the insurance companies come up with an analysis about what it will cost for you to rebuild your house. In guaranteed replacement, they're just going to give you that amount. Here it is, boom. Now hire the people to fix it. Actual cash value is a little different. They come up with that number still, that $400,000 to rebuild your house, say, but then they're going to reduce that amount by the depreciation of the products in your house. Just everything. The roof has depreciated, the siding has depreciated, the windows have depreciated, some of your personal goods inside that have been insured have depreciated. So you're going to get a significantly less amount of money, but your premiums are going to be lower too. So you have to weigh those options when you're looking at your insurance product that you want to buy.
I want to bring something back to Christina. So because I think there's some myths out there. So I'm not sure anybody in this room did that, but sometimes people get second mortgages through Minnesota Housing. And somebody wants to refinance because they got that equity. how does Minnesota Housing handle that if I bought my house for $200,000 and I got $12,000 from Minnesota Housing to help me buy my house? How does that work if I want to refinance?
So if there's anyone in here who used the Minnesota Housing mortgage for their first home, they have $12,000 in a down payment assistance loan, we can refinance it into a step-up loan. So that's the second mortgage, well, the second mortgage program that we have for current homeowners or repeat home buyers. So if you have a first mortgage with Minnesota Housing with down payment assistance, we can refinance it into the step-up loan. That's a wonderful product. You can use FHA, VA, RD, or any of the conventionals that lenders have out there. So they'll just refinance that and roll that into your mortgage for you. So you don't have to pay that back out of pocket.
So I'm gonna bring this back to Trent and Bill. So I've been in my house for maybe 5 years based on today's market. And I did get a rate of, let's say, 4% 5 years ago. Is now a good time for me to refinance if I have some debt? So I have maybe $12,000 in credit card debt. I have $8,000 I still want a car loan. Would that be a good time for me to refinance?
It depends on the discipline. You know, depending on how you are as far as, if you're going to refinance, if you're at 4% and you're going to refinance, do a cash out where the rates are today, rates are probably what, 7 and a half, 7 and 3/8, give or take an eighth. So you got to basically look at the debt that you're paying out and what is that costing you. And then if you're refinancing it, see if there is a, if there's a profit there now. So if you pay off all that debt and you're rolling it into the new mortgage, that's your new mortgage payment. The objective or the key is you cannot use that credit again. You've got to use that credit, and you got to really be disciplined on that credit and make sure that you don't charge those credit cards back up, A. B, don't go and buy another new car and finance it, because the work that you just did to refinance, to get it into this, because you're in a higher rate, but to pay off all that other debt, but monthly, you're still profiting. So let's just use some fictitious numbers. Let's say if your mortgage payment is $1,000, but you got $800 worth of debt out here, but now your new mortgage payment is $1,300, but now you got a $500 profit for the month. Now the objective is, or the key is, don't go out and charge those items again, because basically now you're robbing Peter to save Paul. So you want to add on to that?
Yeah, no, I agree with everything you just said, except you got to keep in mind, if you refinance a bunch of debt like that, you've just probably refinanced it for 30 years. So even though you're saving $500 a month, you're paying on what probably would have been a 10-year loan for 30 years, and that's just going to cost you more in the long run. So there's a couple of things to look at, and you basically said it. You got to look at the math. You got to look at the arithmetic and say, well, am I saving or not? And then you look at it in cash flow per month, and then you look at it in the interest over the period of time, and what are you willing to take in that case? And then, most importantly, don't do it again, because then you're just going backwards.
So
And then one last thing, Henry, another thing you can do, because we just talked about it earlier, because now you've got that profit, make an additional payment once a year towards your principal balance.
So let me ask you guys a question. What is a HELOC and what is a second mortgage that's a mortgage loan? Are they both second mortgages? How does that kind of work? What's the difference between a HELOC and a home equity a HELOC is a home equity line of credit, which I hope I'm using these terms right, but that's like a big credit card. So you can get a $25,000 HELOC on your home, and you can use it to buy something and then pay it back off, and then use it to buy something again. The interest rates are usually not fixed on those, so it'll move with prime rate or something like that. It can be a good tool, but you got to be disciplined. It can be a real dangerous thing as well. A home equity loan or a second mortgage, I would use those terms interchangeably. Actually, you generally will amortize. So you get the lump sum cash. You get the $25,000 and you use that $25,000, and you pay that off like you would any loan over 10, 20 years, or whatever the term is at that point. Okay. Does every bank do an equity loan or a HELOC or a home equity loan?
Mortgage companies do not.
Okay. All right.
And every bank doesn't do them anymore either.
Okay, so I just want to throw that out there, because every bank does not do these type of loans anymore, and mortgage brokers, not every mortgage broker has, what mortgage brokers normally typically don't. What time do we end, 7 or 7:30?
7:30.
7:30, okay, so we still have time, that's great. So here's what I want to ask everybody to just talk about, we're going to go all the way down, is what is the biggest myth that you think homeowners face today about insurance or refinance? What do you think the biggest myth is about, for current homeowners, about refinancing or homeowners insurance? We're going to start at the opposite end with Sophia.
I'm not a homeowner, so I'm new to this.
So you get the pass.
We will allow you to pass. Tim,
Yeah.
what do you think?
I just wanted to add some thoughts about the discussion, high deductible, low deductible insurance. It was kind of framed up to me by my agent in a very helpful manner. I'm not in the insurance business, but it's kind of a stage of life thing. So when I bought my first house, my insurance agent said, well, if your basement flooded, do you have a $10,000 you could scrape together for your deductible? And if not, let's go with the $2,000 deductible. And then as my career progressed and some of my debt got wiped away, that decision changed. And I said, well, yeah, I can come up with $10,000 to cover in a catastrophe instead of $2,000, and now I'm saving $150 a month on my premium. So I think it's good to frame it up that way, based on the time of life. Do you want a higher deductible or lower deductible? And you know, also risk tolerance. You know, you may save $150 of premiums. You have to make sure something catastrophic doesn't happen in the next 4 years to recoup that difference in deductible. So,
But you didn't answer the question on the myths.
the myths.
It was a good
Well,
answer.
Yeah, so I guess the myth is, you know, a lower deductible is always better, and that's not always the case, and just depends on your life circumstance.
Thank you.
Cool.
Bill?
The greatest myth in refinancing?
Or has an insurance as well,
Yeah,
whichever
well-
one you want to take.
Well, I won't do insurance because I don't do insurance, but, you know, I would say when doing lots and lots of refinances, you know, when interest rates drop and everybody's calling and wanting to do it, the greatest myth or mistake is that people get too fixated on the interest rate, and they're not looking at the big picture as to how much longer do you have left on that loan that you have currently with the higher interest rate. How long are you going to be in the house? You know, most of the time, it's arithmetic. You know, I can say, these are your closing costs. This is what you're going to save. This is how long you need to be in the house to recoup those costs. Are you going to be there? I have probably told as many people, you really shouldn't refinance, or you should just make an extra $100 a month payment and you'll pay that loan off in such and such a time, and you'll save more money doing that than you would refinancing. I've told as many people that as I've done refinances for, and I've been in the business for 40 years, so it's a lot of people. But, you know, I think too often, though, people just get fixated on the interest rate, because usually when interest rates drop, that just becomes big news, and that's what everybody's talking about.
Thank you. Trent?
I can't really think of anything off the top of my head, but if I could say a myth about refinancing, it would be, you know, I would say be careful doing cash out refinancing, even though we talked about it earlier, doing cash out refinancing to pay off debt. Because sometimes, again, it just can put you more in a financial steep than you were before you even, you know, refinance. Look at other ways to consolidate your debt versus refinancing and paying it off through your equity in your home. That would be one of the things I would say.
All right, Max?
Yeah, so I'd say, and this helps being towards the end of the line because I actually had time to think about it. The biggest myth that hasn't already been covered is the idea that all equity is remotely equal, and that's simply not true. We've talked about a lot of different ways to get at your equity, and the truth of it is the only true way to get the equity you've built up in your house is to sell it and not buy another house. And then you actually have that asset in cash, but then you can do near anything with. The other kinds of equity, which is just your home going up in value, you paying down your loan, really is going to depend on where you are in your family life cycle, your professional career, your retirement plans, your the cost of living that you have, and just be careful using it for things that aren't going to pay off in the long term, because while your house is one of your biggest assets, it's also one of your least liquid. And so be careful how you use it. I'd also just add real quick, not all lenders are created equally. There's lots of great mortgage lenders out there. There's lots of great bankers out there. You should always price shop when you're getting some kind of financial service, including with credit unions. There's a lot of options out there, and some people can serve your needs a lot better than others.
John.
I really don't think there are many myths out there. I think it's pretty straightforward, but I think term is an issue, mortgage term. A lot of people do push having a shorter term so that you pay less interest over the life of the loan, and that is great if you can afford it. You're going to save a lot of money doing that. But what you do give up by having a shorter term is flexibility monthly. By having a longer term, you're going to have a much lower payment in that. That's nice. You're going to have more money in the monthly, in your monthly accounting, but then if things go wrong, it's just going to be easier to make that payment. But you will pay a lot more money in interest over the life of the loan. And those are just two things you have to weigh. I just see a lot of people saying, do a 15-year mortgage, because the interest that you'll pay is going to be so much less. It's true, but your monthly payment is going to be much higher.
Christina.
All right, there's not much left to say. I agree with every single person on the panel here. I'm going to go the opposite direction just based on personal experience and talking to people many years ago during the Great Recession and when interest rates dropped to 1-2%. I remember talking to several people who had interests at 7%, 8%, and they refused to refinance because they said, and this was true, a lot of people were scammed during the Great Recession. So, and they just refused. They said, I'm not going to do this. But I'm like, you're going to save so much money. I'm not a mortgage lender. It's just, you know, from personal experience and being in industry and understanding what they might have saved to refinance at 1% or 2%, and they were just too afraid to make the call and ask questions. So I would say that's a myth out there, that refinance is always bad. Not a lot of people think that way, but some people do. And so it's worth asking questions, and I'm not pushing refinances by any way, shape, or form, but if a recession hits again and interest rates go to 0.5, it's at least worth calling somebody and asking questions.
Don't we wish?
Yes.
Thank you guys for that. Any questions from the crowd? I'm curious right now. Let me ask you guys this. What made you come tonight?
I can go. For me, I'm a recent homeowner and I'm a first-gen immigrant. Of course, everybody's dream is to buy a home, but then okay, what resources do we have to the city or the housing agency? And online we can find some resources, but I see a lot of income limit, and it's just the working poor thing where you don't qualify for benefits. Also, you're not comfortable, so you just can't figure out what's out there and connect people.
Can I say something to that?
Yes.
Thank you so much for asking the crowd the question, and thank you for your question. And I remember before I bought my home and looking for resources to buy a home, income limits was such a big deal because you're basically the working poor. You have money, but you have too much, and you don't really have money, but everybody says you do. So that's a great point. So I'm just going to say, for you as a current homeowner, there are resources out there, and I feel like Minnesota Housing, we have very, very fair income limits. For instance, for you, you're a current homeowner, so you wouldn't need to talk about income limits for a first-time home buyer or repeat home buyer right now. But just to put it out there, for instance, if you needed to do a home improvement loan, our income limits right now are at $175,000 for a household. So I think that's very fair. So to get into a home improvement loan with that high of an income limit, I think that's pretty generous. And then on top of that, if you wanted to do a secured energy or accessibility loan, there are no income limits for that. So if that was something that maybe you needed to move a grandparent into the home or a parent who needed accessibility improvements, there's no income limits for programs like that. And just in case there's anyone in the audience who wants to think of a refinance as a current homeowner you want to refinance, or if you have family members or friends that you think they want to become first-time home buyers, our income limits, right, they just changed on July 3rd. For a family of 1 to 2, you can go up as high as $134,000, and for that family of 3 plus, it's $142,000.
I'm sorry, just what is the minimum FICO you said for those programs?
Minimum FICO is 640.
Yes, ma'am.
Hi, my name is Victoria.
Maybe at the very bottom, might be at the very bottom, little button. A little high tech here in Bloomington.
My name is Victoria Chambers, and I'm a realtor. And I wanted to attend because I have clients that are looking in the Bloomington area, and I also have clients that have bought in Bloomington. So I wanted to make sure that I knew about the resources, if there was anything different, any offerings that they should know about, to help them with their home ownership or refinancing. I try to make sure that I can be a resource and point them to Minnesota Housing, PPL, Brimmer, for the different services. So that's the reason that I wanted to be here tonight.
Thank you.
Bloomington does have a down payment assistance program.
So here's one thing I do. This is really about current homeowners, but you had mentioned that you're a first generation buyer. So congratulations. There is something that was just passed, and it's going to be $150 million for first generation buyers. $50 million of that is going to go to Minnesota Housing. The other $100 million is going up to MMCDC. Then will come back to the city. So it's very important that you also share with maybe your network these resources that are here at the table, because I do believe knowledge is power, right? So you had some really good questions. What made you come tonight?
I am a first-time home buyer. I don't even. I'm like yelling.
It's for the recording. It's for the recording.
Oh, I'm sorry. Oh, okay.
It's on it.
It's on.
I think it's on it.
I'll hold it up. I think I'm gonna project my voice. But the reason for myself coming is I am a first-time home buyer. I bought my home in 2019. I'm like 4 years in. But the more I learn and I get like assessments, I mean, my home is in Northeast, I'm not in Bloomington. But the more I get the assessment paperwork, the more I'm just like, what exactly is this stuff saying? And I actually want to build wealth. So I want to know what's going on. I want to know how can I build the wealth. My home is a older home. It says it was built in 1900s, but I think it's probably older than that. I think at 1900 is when they started saying, okay, any house at this point is 1900.
It is.
So, there's improvements that need to be made, but, I came to inform myself. Maybe I might want to buy like another home and have multiple properties and create investments for myself. And, maybe some of the nuances that might make me nervous for reaching out to the department. I actually saw Sophia at an event and learned a little bit more about, homeowners in terms of taxes, because I'm an accountant, but I do my own taxes. Maybe, with the information that I receive, I might need to, reach out and receive and work with an external accountant to do my taxes, so that I am more able to capitalize on the benefits that are out there for homeowners. Because I'm only like 3 years in, but I know there's something out there.
But you started. You are a proud homeowner.
We've talked a little bit about a lot of the resources, including housing and the city of Bloomington itself, which are great. I would be remiss if I didn't mention that we are starting in Minnesota a once-in-a-generation investment in green and renewable energy, and that includes home improvement. And the subsidies, potential tax rebates that I'm not an expert on, that you could take advantage of in investing in your house in ways that could hopefully reduce your energy burden, but also improve the overall value, is a tremendous resource if that works for your particular house.
Yeah, I joined also my neighborhood association and learned about the CEE program. I don't know if people are aware of where, you can do home loans through the city and they help you with home improvements. I mean, we did some improvements on our kitchen, but I just wasn't really comfortable with taking that step. I preferred to do out of pocket so that, I'm not continuing to create debt. So, but I've heard about like the solar panels, and that's something also too I kind of want to dive in, but I'm just kind of like taking information as it goes and trying to prioritize, you know, what's the most important avenue to move in, because I can't kind of split myself in multiple directions and try to capitalize on all of those things. So that is definitely something I'm like, yeah, I want some solar panels.
Me
Okay,
too.
I want Centerpoint, not Centerpoint, Excel to pay me or something, you know, absolutely. And to reduce the carbon footprint if I can with a 1900 style home. But, you know, I'm proud of myself for where I've gotten to at this point, and so I'd like to take as much advantage as I can, you know, with what I have created so far.
So
that's
since
why.
you said you're aware of CEE, CEE is one of the biggest lenders of Minnesota housing programs.
Mhm.
So if you do call them, ask about the programs that Minnesota Housing has available through them. They're one of our biggest lenders.
Yeah, I took advantage of the first-time homebuyer program with Minnesota Housing, so I did get that down payment assistance, and
That's great.
I didn't think I could ever buy a home, and I mean, I literally came out of it like coming out of pocket like pennies on the dollar. It took me a while to process it, but I mean, the information is out there, so I came to, you know, better inform myself so that I can make some better decisions, like not being afraid to look at rates for my insurance now. So I will be calling Travelers tomorrow.
We appreciate you all coming out. We're not done yet, but the reason I asked that question is because I do think that good news travels slow, bad news travels fast.
Yep.
So any feedback that you can give to us, but also to the community and say, hey, we went to this event Bloomington hosted, and I learned some information, because I do think one of our issues we have, especially in the BIPOC community, is we don't share the resources that others have to then get to that next level. Because really, we want you to keep this asset, because this is a way to build wealth. This is generational wealth. As the young woman shared earlier, she inherited her house from her parents. That's wealth being created right there. They did what they needed to do to help her generation. Now how do we help the next generation? So I want to ask everybody on the panel, when you look at home ownership, how do we talk more to people in the community about protecting their asset in the form of generational wealth? And I'm going to start somewhat in the middle, and I'm going to start with Trent.
I knew you was gonna start with me. But to protect your assets, I mean, equity is one form of generational wealth. And I think we really need to have more conversation about other areas of generational wealth. Well, and even before I get to that, the first thing we got to do is we got to start having the conversations at the table with our families and start talking to them about, you know, I have this for a reason, and I'm leaving this to you. But why I'm leaving this to you, because I want you to move it and pay it forward to your kids. But equity is one form, but the other form is insurance. Are we insuring each other, or are we insuring ourselves? Everybody thinks that, especially in the, you know, I'll just say it, in the African American community, we look at it as an additional expense. But we also got to look at it, okay, if that's an additional expense, well, what are some of the other things that you're spending money on per month, which that could go into a life insurance policy, $100,000 or $150,000. I mean, personally, I have 3 different life insurance policies, and I have equity. So God forbid anything happens to me, my son is going to be well off a little bit. But we're not having those conversations. See, we just think it's, you know, nothing's ever going to happen to me. That's not going to happen to me. But yet and still, we see every day when somebody has an untimely death, what do we see? A GoFundMe. Mm-hmm. And that should not happen, because we should be preparing ourselves for generational wealth. And those are other aspects of generational wealth: equity, life insurance, conversation. Having these conversations at the dinner table, having these conversations at break or whatever, if it's with a loved one, husband, son, daughter, wife, etc. That's generational wealth, and that's how we have a piece of this pie, and how we can keep that pie moving forward versus what's happening today. That's just my humble opinion.
Or we're going to go to your left, we'll go to Bill. Oh, to your right, I'm so sorry.
You know, Trent is always such a tough one to follow. You know, You know, generational wealth is an interesting thing, and I like what Trent had to say. It's about having those conversations to start with, because if you don't know, you don't know, right? And Trent and I have had the opportunity for the last couple of years to go out and talk to some high school classes about building wealth in owning, in home ownership. And it's really interesting to watch these kids. You know, we talk about things that everyone in this room probably already knows. It's like, well, how do you know how you can actually build wealth and get more wealthy owning a home versus renting? And you say, well, you know, when you rent, your rent goes up every year. If you own a home, your mortgage payment's going to stay the same. I don't get into a whole bit about taxes and insurance going up because that's just, but your mortgage payment's going to stay the same. So, you know, in 5 years, your rent might go up $500, but your mortgage payment's going to stay the same. So you're saving money right there. And then every time you make a payment, you're getting more equity in your home. And your house usually goes up in value. So that value, that equity is yours. And you get to look at these kids, and they're like, their eyes kind of get big, like, oh, really? How much money do I need to buy a house? I mean, these are 16-year-old kids, and, and they get pretty excited about it, and they hadn't thought about it before. So I think having that conversation is the beginning of generational wealth. And fortunately, last year at our state legislature, we got a law passed that says that kids in high school now have to take a course in personal finance before they graduate, which I just think is so good because, finance has gotten difficult, and people can get taken advantage of pretty easily nowadays by unscrupulous folks in finance and insurance. So I think we need to make sure that our youth are coming out of school with a good understanding of the basics of finance and making sound decisions, and not doing that old bit like, you know, most guys my age did in college, where you filled out an application for a credit card because you got a T-shirt in college, and then you go and you blow it at the bar, and the bill goes to your mom and dad, and you never even thought of paying it. And then 6 years later, when you're applying with your wife for a home, and they're like, "How come your credit score is so messed up?" You know. So anyway, we got to avoid that kind of thing.
All right, Tim, we're going to go to you next.
Well, that was a very specific example. I feel like you've dealt with that. So a long time ago, before I was the city assessor here, I was a residential appraiser. Been in thousands and thousands of houses, inspected. And what I'd say is take care of your property. Maintenance issues proliferate. You get a leaky window or a leaky roof, and all of a sudden the window sills are rotting, and then there's mold behind the plaster, and now you've got a $20,000 fix instead of a $1,000 window replacement. You know, we see this time and time again. People get an inspection, the sewer line is cracked, and they say, I'm going to kick this can down the road, I'm not going to spend the $4,000. That sewer line gets blocked, it breaks, and all of a sudden you've got a flooded basement, you're ripping up all your flooring and repairing all the trim and mold remediation again. So I would say, you know, in the terms of generational wealth, if you're planning on passing this asset down and building wealth, take care of it. You know, a $1,000 investment now can save you a $20,000 headache later down the road.
Sophia.
So I'm Somali and I'm a Muslim as well. So it's really interesting. I thank all you guys for just teaching me a lot. It's nearly taboo to be a homeowner. Maybe about 20 years ago, but people are slowly finding ways to go around like Sharia laws and things like that to kind of just figure out different terms and languages to use to be able to either get a loan. There are a lot of people in my community that will have like a large sum amount of money saved up. So, and like no credit because like that's just like not spoken about. So I really like that you mentioned just speaking about it at home. And there's people like me who's first generation, and I can like go out and just kind of just talk about, hey, what, you know, how can we make this a norm? Like, clearly, like, we're here almost like 30 plus years, and we're actual like citizens and want to be here and plan on having generations here. How can we be homeowners? So education is just like really, really important, and hopefully I can be I'm actually thinking like maybe I should be a homeowner. So that's one thing to kind of just keep it like generational wealth going in all communities, of course. And Working for the Department of Revenue, I have been able to just learn so much about figuring out how to have resources accessible to people and myself. You can go on our website, which is revenue.state.mn.us, and
Repeat that for
literally
you one more
just
time.
revenue. Well, there's a handout that I left with the revenues directory in everyone's bag, and I can hand out some to you guys as well. So you're able to just go on the website and just literally type in all different type of information that you have when it comes to taxes, like property tax refunds or homestead, and it'll just lead you to all different type of links or contact information of who you want to reach out to and have specific questions answered or email them. And even talking to like your tax preparer, choosing like a specific, choosing tax preparers or tax professionals that are suitable for you, and figuring out how they can relay the information kind of in like layman terms for you to actually understand. And keeping up with tax law changes is really important too. And those are just some of the ways that you can kind of just keep generational wealth going.
All right, thank you. I'm gonna go to Max, but I want to remind you again, we talked about this a little bit, you guys. For those of you that know friends or family members that would be first-generation buyers, there's down payment money here in the city of Bloomington, and there's also the money that's gonna be coming out at the state level. That's gonna be $150 million that we're gonna have to give out. Max, go ahead.
So first of all, everything that's been said before has been great advice. What I would say is, and Trent covered this a little bit earlier, don't overspend on your house. For a lot of reasons, your house will probably be one of your biggest assets, but it really shouldn't be your only asset. And so find a house that you can comfortably afford. Hopefully, as your career progresses, that'll become even more comfortable, so you're giving yourself a raise there. If you buy yourself a house that you're gonna have to chase, that's going to be miserable, and if that ends up being your only asset financially, you're going to end up paying a lot to capture that equity.
John.
This was touched on earlier, but maintaining your credit prior to purchasing your home, that's probably the best place to build the wealth there, because when people are quoting rates here, 7%, that's for an ideal borrower. That's with a borrower who's got a great credit score over 700 or something like that, with low debts, so they have a low debt to income ratio. That's where you're going to make the most of your savings. Right now, someone said that the average value of a home was $360. I did some calculations, or I used a online bank calculator, mortgage calculator, and at 7% for a $350,000 house, every 0.5% that goes over 7% is an additional $60,000 that you're going to be paying in interest over the life of your loan. That's a lot of money. So by maintaining your credit before that and keeping your debts low, you're going to get a better rate as opposed to the rate that you will actually be getting when you find out you have a 680 credit or high debt to income. And one other thing, if you do have any issues with your mortgage companies, I don't think a lot of people know this, but the Department of Commerce is a regulatory agency. So you can go to our website, mn.gov/commerce, and file a complaint about your mortgage company, your realtor, your insurance company, and we'll investigate it, and we'll give you some findings, and it may sanction them, and sometimes it can actually help you financially to get something back that you've lost. That's it, yeah.
Christina.
All right, there's not much more to add. Everyone on the panel has been so eloquent, and I agree with everything that everybody has said. So I'll just touch again on what Henry mentioned about the recent legislation passing first-time homebuyer bill. It's first-generation homebuyer money. So already, Bloomington, again, has money, but the $150 million that the legislature just put in the public, put out there for Minnesotans, eventually will, when the programs, we, again, at Minnesota Housing have $50 million of that money. The hope is to have first-generation home buyers helped up to $50,000. So if you have networks that are looking to be first-generation home buyers, that's going to be something that's coming soon. The programs are in the process of being created right now, so that's going to be very key in creating generational wealth for people down the line. And for Sophia, who mentioned that being Somali and Muslim, it is true that we've heard anecdotally a lot of Somali people that don't buy homes just because we're interest-averse people. But there are programs out there, and there are discussions that I know of working with the state for creating programs that will enable people who are interest-averse to buy homes using the language that they understand and that agrees with their religious beliefs, so that everyone in the state of Minnesota can build generational wealth. We know, as Trent mentioned, that home ownership should not be the only way we generate generational wealth, but it is the number one way people do. Right now, it is. So even though we do need to diversify the ways that we generate wealth, but right now, for most people, home ownership is the way to build generational wealth. So we want to make sure that everyone in the state has access to that, regardless of your race, your religion, or your political beliefs.
I want to add to that. I do think, so again, the city of Bloomington has down payment money that can be layered with currently right now Minnesota Housing's money or any bank's money as well. So if you have friends out there that want to looking to buy in the city of Bloomington, that money can be used. There are some income guidelines on that, but we can go over that on a different time. But Erica Coleman is also in the room. I'd like to give her a major shout out because she helped us put this all together. I go way back with Erica. But I just want to say, you guys, this is something that we would like to do more of and change the topic as well. This is something that I don't think people really understand of how important it is to protect your asset. We know a lot of people did lose their homes in the foreclosure crisis. We don't want to see that repeat. One thing I'll leave with you, too, that they all talked about, another way to me to build generational wealth is what we call the rule of 72, right? It's how you invest your money in the market, right? So all of us hopefully are working somewhere where we have a 401k, a 403b, something, but if you go and learn about the rule of 72, while your equity is growing in your house, you can also be putting money away in the market that will also grow for you over time. You should also have life insurance. The number one way to pass on life insurance outside of home ownership is life insurance, and it's tax-free, you guys. Now that you are also homeowners, please talk to somebody about how to protect that asset as well if something was to happen to you tomorrow. How do you want to have your house transferred if something was to happen to you? But thank you, panelists, for showing up tonight. We had a great session. Thank you guys for coming. And again, thank you, Erica and the City of Bloomington.